Anything about discussing?
So maybe we'll continue on. Can I share my screen here?
Yeah.
Um, Maybe what we'll do is continue on our discussion from yesterday. We're looking at SPY, and we were looking at the single leg dashboard uh, analytics. So this here, let me close this here. I'm going to close the menu here just to get a wider view of these analytics. And just a quick recap. What this page does is looks at options trades, in this case SPY, because that's the symbol we're on, and takes uh, all the single leg trades that were reported on the Oprah feed. So it excludes trades that were reported as multi-leg or contingent, isolates them, and then performs different analytics on those trades so we could get some insights, how people were using options, how end users were using it, what the order flow, and so forth. And here we have different ways to analyze those trades, right? That's what this dashboard is. There's no one right way. There's no one way, you perform an analysis to try to answer a certain question. If you have a different question, you may try to perform a different type of analysis on here. So we talked about uh, the top part up here, these graphs. Yesterday, we discussed the visual over here of the different expirations available in SPY, the 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 distribution of the trades by expiration, by calls and puts, and then how were those options impacted? Uh, and that's where the implied volatility. Then we came down here and started discussing this table of data. And this table is numerical. Here it's a visual um, graph. Now we have this table with the data in it. And here we also organize each expiration available to trade options. We could expand it to show all of them. So you could see here in SPY, there are a lot of different option expirations available to trade. What this indicates is that, you know, this particular expiration has listed options. That has listed options. There are market makers and specialists providing bids and offers. So these are things that you could trade, right? That are available to trade. And you can see that in SPY, there are a lot of expirations, and a lot of them you have, you know, yesterday, this is yesterday's, we're not open. You have a 0 DT, an option that expires same day, then option that expires next day and next days. So over here, all the way at the end, trading days left. This shows us the number of trading days left in that expiration. So yesterday is 0, then you got 1 day, 2 day, 3 day, 4 day, and it gives you a sense of, how many different expirations and how far out they go. We talked about these events, and these events are something that we capture if we're able to spot or detect a certain event that could be material to the options. Obviously, we can't capture every event out there. There could be news and stuff everywhere, but if we capture it, we put it in our database and it's displayed here. So over here in SPY, we see that there's a dividend. It's expected to go as dividend September 20th. Well, that's material to options because options, part of the options pricing model is the cost of carry, right? Your interest and dividend. And if you have an early exercise component to your options, well, you may want to analyze options if it's a good candidate for an early exercise before the dividend, because when you have, like, say, a call option, well, you own a call option that's deep in the money. Like, it's a contract, so you're not entitled to a dividend. A shareholder is entitled to a dividend if you own the stock. If you have a call option that is essentially behaving like the stock, moving 1-for-1 with the stock because it's so deep in the money, well, before a stock goes X, you might want to exercise it, convert your option to stock so you could get the dividend. Otherwise, you'll be out of it, right? You're not going to get the dividend. You're just going to have you have a call option. That's it, right? You're not entitled to a regular dividend for a call option. So that's material. An SPY, I don't know, it could be like almost $2 in dividends. So for one contract, it's $200. So it's what we detect that could be material, we will list it under those events. SPI doesn't have earnings, but if it had earnings and we detected it, would put there because earnings are a binary event, implied volatility, and option prices are priced different. So that's the events. Now we have these at the money implied volatilities. And this shows you what we find the strike that's closest to that, the money. And we say, what is the implied volatility? That strike. And then we list it here. So you get an idea of what, just by scanning with your eyes, what the implied volatility looks like for each of these expirations and how it changes as you move out further in time. So the way these expirations are ordered is by nearest term, shortest to longest. So now that we have the at the money IV, what we see that there's a difference between implied volatilities as we go out through expirations, but we talked about this yesterday, which is basically what does the vertical skew look like? So vertical skew is where the strikes within the same expiration are different, right? So implied volatility for each strike is different. Doesn't have to be like, for example, let's go out here. Here's a 9 days out, right? So this traded 308,000 contracts. Well, on August 16th, the implied volatility at the money is 30.6. But that doesn't mean it's 30.6 for every strike available to trade. And we call this a vertical skew, right? A skew where the option volatility changes. But we don't know until we look what the skew looks like, because the skew could look where the implied volatility on the wings and tails are going up, so it look like a smile. It could be a flat skew. They could be almost all the same, or it could be where the implied volatility to the downside is going up, to the upside is going down, or in reverse. So we need to check that. What does the skew look like? And because there's so many strikes, what we could do just to try to create benchmarks and reference numbers is we could say, okay, let's create a benchmark so we kind of get an idea what it may look like, throughout. So here we reference the 25 delta put, downside put, and a 25 delta call, an upside call. And we say the following. If we use this at the money implied volatility, 30.6, and we assume that it was 30.6 on every strike. So we just ran 30.6 on every strike. And then we found the 25 delta put and said, well, is it 30.6 or is it different? And if it's different, how much is it different by? So here, this is saying that the 25 delta put is 16% higher than the 25 delta put IV, 16% higher than the at the money IV. I'm like, okay. What about the upside call? What if we found the 25 delta strike call and said, is it 30.6? Well, if it's not, how much is it different? Here it says it's 23.9% lower. Okay. So now we kind of have an idea of what the skew looks like, potentially where as you go down in strikes, the implied volatility looks like it's coming up. As you go up in strikes, the implied volatility is going down. And so far, it looks like it's sloping down faster than it's going up, uh, sloping up to the downside. We could click on that, kind of get a visual. The other thing, as it's loading, is that this is what it looks like, but how did it change? Remember, we were talking about change. So how did these strikes change relative, implied volatility change relative to the previous day? So how did the trading or the news or whatever impact these prices? So here, this is telling us that the at the money implied vol, that strike, the increased 33% yesterday. The put at the money increased by 32.6%. And the 25 delta call implied volatility increased by 22.4. So this is shown that the greatest increase in the IV was at the monies, followed by the downside put. And then there's an increase in a 25 delta call IV, but not as much as in the downside put and at the money. Okay. So because I clicked on it, this is what this August 16th expiration looks like. So you could see the different strikes below, right? And I could expanded this because it has a lot of strikes, so you could expand it if you want, but this kind of zooms in where the volume and at the money is. And what do we see here is we have different strikes in August 16th expiration, and we see the distribution of trading volume. The bars represent the total volume on that strike, calls plus puts. The calls are in the yellow bar. The puts are in the blue bar. So if we see a very big yellow bar and a small blue bar, means most of the volume was in the calls, and vice versa. If we see kind of like a yellow bar stacked, a blue bar stacked on the yellow bar that looks the same, almost the same, then it means that the volume in the calls and the puts were more balanced. So here we kind of see just a visual that as you go down in strikes, the trading volume was mostly in the puts, because we see these big blue bars, right? Mostly with no yellow, where the yellow is not very visible. As we go higher in strikes, above wherever here is like 510, maybe up here, all the way up here, then it becomes much more skewed towards calls. Okay, so that's how yesterday traders and users were using the options in August 16th expiration. So we get an idea of the trading activity, right? And then we could see these bars. The longer the bars are, that means the more trading happened on that strike. So here, the 500 strike appears to be, the most trading volume. I'm hovering over right now, over 14,000 contracts. And it looks to me that it was mostly puts. And you could see here as I hover over it, for a VWAP price of $6.72. In other words, if we took the volume weighted average price of all those trades, single leg trades in the SPY 500 put, traded for an weighted average price of $6.72. So that's really quickly, we're scanning and getting an insights and idea how things are trading. Then we have these other lines, right? These lines represent the implied volatility of those options. So this solid gray line here, the solid gray line, that shows the implied volatility of these strikes day before. So then we see that the day before, you can see the implied volatility to the downside is moving higher. The implied volatility to the upside strikes are moving lower. And then the question is, well, how did it change? Right? We had news, we had trading activity. How did the implied volatilities change? Well, that's this next line over here with the circles. So the green circles represent that the implied volatility went up. If it was a red circle, the implied volatility from the previous day went down. So here is just obvious that this entire line is above the previous day's line. So implied volatility went up in all the strikes. And we could see that it went up. And just like our table confirmed that the increase was greater, see the distance, the increase was greater to downside strikes than the increase to the upside strikes. So you can see here, it increased all around the curve, but this tail, the downside tail, got pulled up higher, by bigger amount. So we're right up at 9:30. I think I will stop right there.
Awesome job, D. Great discussion again today. Thanks so much for everything, my friend.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons. Everyone have a great day. Bye.